Welcome to For Advisors by Advisors. I'm your host, Evan J. Mayer. Today, we are going to talk about tax loss harvesting. This is something that I've been implementing in my practice for a very long time, and it's a huge value add to advisors for their clients. And it's something that I would suggest all advisors consider implementing if you're not already implementing. Depending upon how you manage money, it can be somewhat difficult too. If your money's mostly in mutual funds or ETFs, it might be a little bit more difficult to tax harvest in the situation that you might have owned those positions for quite a while and there are no losses you can take. First and foremost, what is tax loss harvesting? Well, tax loss harvesting is selling things that are down that you currently own with the concept of creating a capital loss for tax purposes that are positions you may want to purchase back in the future. There are opportunities to do this, and there are opportunities that can actually void the tax harvesting situation. So first and foremost, our practice is managed mostly on individual securities. So individual stocks, individual bonds, individual preferreds, individual structured notes. Structured notes are obviously not a great vehicle for tax harvesting due to the lack of the secondary market. But it's an excellent opportunity specifically for equities, preferreds, primarily. Those are the two things that we will harvest. So what can get in the way of tax loss harvesting? Well, if you sell things when they're down and then you buy them back immediately or sometime within a 30-day window, the IRS disallows the loss. So as an example, if I bought Tesla today and I sold it 3 months from now for a 30% loss, meaning I could take that loss for tax purposes come tax season. And then I buy the stock back within 30 days. The IRS says, no, that's called a wash sale. So you can't buy the same security or technically a substantially identical security. So options can be an issue. You can't, sometimes you can't sell a options contract for a loss and then buy the same options contract back, even though it might be on a different year or a different month of expiration. So, but specifically talking about stocks in that manner, as long as you you buy a stock, you hold it for over 30 days, you sell it, and you don't buy that stock back within 30 days, you'll avoid the wash sale. So June happened to be an extremely advantageous time to tax harvest. In my prior firm, they actually had a software through Envestnet that actually allowed tax harvesting through a few clicks of a button. Made life a lot easier. We did find a way to do it that made it pretty easy, just using this Excel spreadsheet that we created. But it's not nearly as time consuming as you may think. It probably took us a day and a half to tax harvest. We normally do it towards the end of the year. However, when the markets have significant drop like it did, and keep in mind from January through the end of June, this was the worst drop over a 6-month period to start a year since 1970 in the stock market. So it created ample opportunity. So the first thing that we did is we looked at the positions that were down, and we looked at if there was any possible big events coming up for any of the stocks that were down. And we looked at stocks that happened to be down $500 or more. Okay, so depending upon how large a client's portfolio is, if a client's portfolio is extremely small, tax harvesting wouldn't make necessarily a lot of sense. So in our case, we looked at 500. I've spoke to other managers, that won't tax harvest unless it's $1,000 or more, and that's okay. Everybody's got a different methodology, but we wanted to take the best advantage of it we can. So the first thing we did is we looked at all the positions in our portfolio that were down more than $500. Then we looked at all of them that had any potential reporting. If they had an earnings an announcement or earnings date, if the earnings date fell within that 30-day period of time, we did not use that in the tax harvesting at that moment. We might have gone back to that. The second thing we did is we wanted to make sure there was no big material events that could come up. Now, sometimes material events come up. They come out of nowhere. A company buys another company. The company that got acquired ends up bouncing up by 30, 40%. Obviously, any companies that are in the middle of potential mergers or where there's a big news that could pop the stock way up, we obviously would avoid tax harvesting that stock in that moment. So what we did in June is we came up with our list and we went forward and sold those positions with the idea that within 30 days, after 30 days, so 31 days and on, we would repurchase back those stocks while creating the loss for the client. So as an example, if a client had a portfolio of $1 million and they had 10 positions that were down and 90 positions that were up, and the 10 positions that were down created a loss of $80,000, then for tax purposes, we would have that $80,000 carry forward going on. But let's just get back to where we were. So we sold the positions, and then the question is that we want to stay in the market. We want to stay in those specific sectors. So where were we selling the most of? And given where we sold in June, most of what we sold was more in the tech sector. Let's go ahead and say it was about 60% tech, 40% was in other sectors. Okay. So you could buy a replica ETF in return. It's not necessarily going to gauge the same stocks that we had sold, but would get us as close as we could. So you could buy a replica ETF such as Triple Q or SPY or, for the S&P 500. And that's what we chose to do. We chose to buy replica ETFs for that moment of time, so that while if the market did go up, and it did happen to go up significantly in July, we would not lose out on our potential upswing. We might lose out, we may not. We may actually gain because the ETFs outperform the current stocks that we had sold. So in the month of July, while we were tax harvesting, the money was invested in replica ETFs. And then when we thought was appropriate, we reevaluated the stocks after the 31 days and then repurchased the stocks back that we wanted to own and sold the replica ETFs or the ETFs that were, similar, and repurchased back our stocks, hence realizing that loss for that client. The reason we did it in June was market again was way down, and it also will give us a second option where if the markets bounce back in towards the half of the year, and I'm not necessarily anticipating that's going to happen, but let's just say it does happen, and we want to sell some of the gains and we want to take some of the risk off the table for our clients, we can rebalance that risk and do so because we have that loss carry forward and we can use that. If not, and the market continues to drop, we can go ahead and harvest a second time come December. And again, there's no June, December, January time you can do this. You can do it whenever you think it's the most appropriate time for your client. And given where the markets are, I think analyzing this June, there were a lot of great money managers that ended up doing that. And there are softwares out there that tax harvest dependent upon what firm you're with. So it is something to keep in mind. Now, you could also sell those positions and purchase new positions that you like if you happen to not like those positions. But for us, and the definition of what tax loss harvesting is in our situation, it is actually selling positions that we currently own that we still want to own, waiting that 30 days so the wash sale rule applies. So we understand long-term losses and long-term sales, short-term sales and long-term sales will wash against short-term gains and long-term gains. Okay. Now, if you get to a position where all the assets are with you, so that hypothetically in the illustration I gave you earlier, where a client has an $80,000 capital loss carry forward, and December 31st rolls around and you don't sell and buy anything else, and that's what the actual loss will show for tax purposes, you can't take that against your income. You can actually only use $3,000 that can offset actual income. So do keep that in mind. But on a client that has $80,000 of losses and $3,000 is used towards income, you will have $77,000 losses that will carry forward to future years. And it became huge for us last year. Last year, we actually had quite a big deal of gains. And for our clients that have been with us for a long time that we were able to harvest for in years past, it gave us quite an opportunity to de-risk the client without them experiencing a huge tax burden. So to me, if you are not offering this to clients, and the scapegoat is that I'm not a tax professional, I do not give tax advice, and I don't either to my clients. But this is not really giving tax advice. This is actually providing a service in the investment portfolio management. and providing alpha for your clients, which at the end of the day is what they pay you to do. It's a great opportunity to do it. So a couple things to keep in mind, again, with the tax loss harvesting: can't buy the positions back within 30 days, can't buy identical securities or what they would call substantial identical securities. And that could include derivatives. So be careful there when using derivatives. There is ways to do it where the wash sale rule might not be enacted. But again, speak with your tax professional in regards to that. And then keep in mind that the capital loss carry forward does continue. There is no like 3-year window where like, yeah, if you don't have any gains to offset and use those capital losses to carry forward, you don't have any of that to use in 3 years. Well, you're going to lose all your losses. That's not the case. Actually, upon passing, your capital loss carry forward does go away. So that is something to know. So if you have elderly clients, keep in mind that if they have significant losses, tax loss harvesting might not necessarily be a benefit to them. Keep in mind, you cannot do this with qualified accounts. If you're a financial advisor and you don't know that already, you should know that. This is for non-qualified accounts. This is for, revocable trusts. Irrevocable trusts could be for all kinds of trust accounts, but specifically when it comes to qualified accounts, it does not work against qualified accounts. So let's make sure we know that. And it's a great strategy. It's great alpha to use for your clients if you're not already doing it. I would venture to say that of my clients that have relationships that are outside of relationships with me, I don't think there's more than 1 or 2 of those advisors that actually are tax harvesting. So we actually, I advise to the client what they need to advise to their advisor. And again, as a fiduciary, that's my job, and that's what that's what we're meant here to do. So hopefully you found this episode useful. If you didn't find it useful and you already knew about it, then excellent. We reaffirmed what you already know. With ETFs, actually, for passive ETF portfolio managers, there is ways to avoid the substantial identical different ETFs that are out there. So keep in mind there is a way to do that. But hopefully you enjoyed it. And as always, we love your feedback. If you enjoyed the podcast, didn't enjoy it, maybe there was something I said that was completely factually incorrect, please let me know. My email is evan@fortunawealth.com. You can also follow us on Instagram. Our Instagram tag is here, and our LinkedIn tag is here. And you can follow us on either one of those as well. So hope you enjoyed it. And again, this is For Advisors by Advisors. I'm your host, Evan Mayer. Hope you have a great day.